This video is an introduction to Chapter 7 of Simon Bennega's Principles of Finance with Excel. So after the introduction of the chapter, he goes to 7.1 and talks about the difference between accounting statements for financial models and accounting statements for accounting purposes. And basically the difference is how things flow into current assets and current liabilities. For financial models, we separate out what has to do with operations. So if you'll read this section, he explains it pretty well. We also did a homework problem in class yesterday, exercise 1, where we looked at several activities of the firm and their values, and we decided, are they operating assets, operating liabilities, or neither. And then we put the same numbers into a form of operating current assets and operating current liabilities. Then we moved on to a problem at the end of the chapter, exercise 2, where we built out a financial model. And that is basically walking through section 7.2 in the textbook. So after you read this, you'll notice that almost all the numbers that we used in our class exercise, problem 2 at the end of the chapter, went along with his numbers in this example in 7.2. So as you go through this, you'll notice he had about 5 extra zeros on his initial sales and his initial balance sheet items, but other than that, it was very similar. So don't only look at the solution to exercise 2, but also come back and work through 7.2 here. Where we ended in class was at the bottom of the balance sheet. So we got down to total assets and total liabilities and equity, and took year 1 calculations, projected them forward to year 5 just by copying, and then we had 5 years of pro forma statements here. The next step was to calculate free cash flow. We didn't have time to do that in class, but after section 7.3, where he extends the model to years 2 and beyond, he goes to section 7.4 and looks at the free cash flow produced by the firm's operations. So basically the free cash flow is the profit after tax, and then we back out and add in a lot of different items. So what we would do in our solution on the class problem is take the profit after tax up here from the income statement, add back depreciation because that's not a cash expense, that's just something we use to calculate earnings. So we need to reverse out what we put in. Since we're reversing out the depreciation, we need to add back in the increase in fixed assets. And when I say add back in, technically it's coming out. So what we're saying happened to the firm here is that the fixed assets at costs went from 1070 to 1264, and so that implies that the firm invested that much money in, let's say, PP&E, and so that was actually a use of cash, so we need to show it as a negative down here. At the same time, we're backing out the depreciation, which was sort of the earnings version of that investment in PP&E. So depreciation was how much of the total amount of fixed assets at cost we were able to depreciate that year on the income statement. The change in fixed assets at cost was how much we actually spent on PP&E. So we'll reverse out the non-cash number, add in the cash number as a negative, subtract it out in his terminology. And basically we do the same thing with the changes in current assets and current liabilities. He covers this well in the chapter, so be sure and read through that. We're also going to add back our after-tax interest on the debt. So we paid interest up here. We got a tax break for that, and what we want to reflect on the cash flow calculation is the after-tax portion of that interest. So we'll take the interest times 1 minus the tax rate, make it a negative, and that will adjust our profit after tax again toward free cash flow. Then finally the same concept, opposite signs on the interest that we earned on our cash and marketable securities. And that's how we get from the profit after tax line in the income statement to the free cash flow that we're going to use in our DCF calculation. Notice he does this in section 7.4, beginning on row 42, 43. He also tells us that he's going to hide some rows, the income statement and the balance sheet, so that when we come over here to page 230, I guess we just hid the income statement, not the balance sheet. Notice that there are rows hidden here. Between rows 12 and 25, there are rows hidden. Also, between rows 41 and 45, there are rows hidden. He goes on in 7.5 to do the consolidated statement of cash flows, but that's getting a little bit ahead of the homework, so we'll back up and focus on just what we're going to do with the free cash flow and how we're going to discount it. In section 7.5, he goes ahead and creates a consolidated statement of cash flows. And so here we're just picking and choosing items from above so that we can separate cash flows into three different activities: operating activities, investing activities, and financing activities. Moving on to section 7.6, we're going to use those cash flows that we calculated to discount them and create a DCF model method. And this is a method that you're familiar with, where we forecast out the cash flows and a terminal value, and then we discount those back at the weighted average cost of capital to get to an NPV. That NPV that we get is actually the enterprise value of the firm, so we have to add to that our existing store of cash and subtract off our existing debt burden to get to the estimated value of the equity. And then if we have a share count, we can divide by that to get a share price. We'll get into that in some of the homeworks. Notice here, this is a little bit different than we did in class. He's putting his terminal value in the final year, and he's using the terminal value calculation method, not a cash flow multiple method, to calculate that $30 million terminal value. We'll do that in an example soon. What may also jump out at you is his use of NPV. Remember the NPV rule that we talked so much about, the pitfall? Here he's not doing that. He's actually discounting beginning with the first year. And the reason he's doing that is because he's assuming that cash flow comes at the end of the first year. He'll change that assumption in a moment, but that's why he's not pulling the first value out, because he actually does want that first value to be discounted at a full year's rate in this example, so he doesn't pull it out. I stressed the pitfall so much in class because I want you to be aware of how the NPV formula works, but at this point forward, we need to be conscious about, do we want to discount the first year or not, and then do so accordingly. So he goes through all the math to show how that works, and then summarizes in section 7.7 how to do so. Notice that in step 6, he comes back and adds a mid-year valuation. So if he's saying that we discounted even the first year at a full year worth of discount rate, now he's coming back to the NPV formula and multiplying it by 1 plus the WACC to the power of 1/2. And what that does is that increases it by WACC growth rate for 1/2 year. And so instead of this value being fully discounted, it got fully discounted for a year, and now it got inflated again for half a year at the WACC rate. And that's his way of reflecting that each of these is occurring at the middle of the year instead of at the end of the year. Most of the examples we did in exam 1, module 1, we assumed they happened at the beginning of the year, therefore we didn't discount the first one at all. Had we done it that way, we could come back and actually deflate everything by half a year. We'll see examples of that in the problem set. He moves on in 7.8 to apply data table sensitivity to these. And in 7.9, he gets into some theory that we don't need to cover in this course. That's a quick overview of Chapter 7. Now let's jump to the exercises and start working through some.